This is Movers and Shakers, where we interview the upcoming generation of Make It Happen multifamily investors to share their story.
Welcome to the Movers and Shakers podcast. My name is Gino Barbaro, co-founder of Jake and Gino, multifamily investor, educator, father, mentor, and I am joined by my co-host, my brosif, Joshua Ryan Rusin, the community director here at Jake and Gino. Mr. Josh, how are we doing today?
G-Father, doing well. The Jake and Gino team is expanding. We're making it happen, changing a lot of students' lives. How are you doing today?
I am doing good. Back-to-back calls this morning, ready to go. Like you said, it's like Groundhog Day for me. We get up in the morning, we do something, we figure it out, wake up the next day. It's the same thing. It's the entrepreneurial life, right? It's a lot of fun. And there's a lot of figuring out, and it's just like multifamily real estate. We're playing the long game, right? We're out there learning and just taking risks and not worrying about what anyone else is saying, not worrying about the haters, just focusing on what we need to do, right, Josh?
Absolutely. Showing up every day and focusing on being better than we were yesterday and putting it all on the field, right?
Great. I love that analogy.
Well, today we have a very exciting guest. We have Aaron Nelson. A little bit about Aaron. So he's the owner of a 30-unit complex in Kansas City, Missouri, and several rentos in Tacoma, Washington. Through strategic renovations and repositioning, Aaron has created over $1 million in equity in these properties. Wow. Aaron works as a real estate broker in Western Washington who specializes in helping investors build their real estate portfolios. He holds a Doctor of Pharmacy from the University of the Pacific and an active pharmacy license in Washington State. Aaron, welcome to the show.
Thanks a lot, Josh. Appreciate it. Glad to be here.
So Aaron, that's quite the background here. So, I mean, let's just kind of talk about your story. Why did you go into pharmacy? You know, why did you transition out of it? How did we get here?
Sure, absolutely. So I went to school to be a pharmacist, like you mentioned in my bio. I graduated from the University of the Pacific in 2008. And after floating around Southern California for a while, because I thoroughly believe that at some point in everybody's life, you have to live somewhere that's warm and near a beach. My wife and I actually decided to move up to, there you go, Gino. Decided to move up to Washington. I took a residency program up there. A residency is like a year of post-grad training in the medical world or in the pharmacy world. And up in Washington, we ended up purchasing our first home, and that was a cosmetic fixer. It had beautiful 1970s yellow tile in the bathrooms and color crayon on the walls. And that was about 2012. And so 2012 in Western Washington was right when kind of everything bottomed out and stuff started to go back up again. And in this case, this guy had just been trying to sell the house for the last couple of years. And I think he kind of given up because usually, when you go into a house, it's all nicely staged and it's, it looks really perfect. And in this case, it was just kind of a disaster, but it was all easy stuff, all easy cosmetic stuff. So at the time, I was working for a large company that ended up going through a massive reorg. And several of the people who I would consider to be my mentors actually ended up getting laid off. And that didn't really make any sense to me because, these were really good people who put their blood, sweat, and tears into running this award-winning pharmacy department. Many of them who had worked for the company for over 20 years. And within a matter of like 6 months, they were all looking for new jobs. And so it was at that moment that I realized there was no such thing as job security in the W-2 world. So I started looking for answers. I went on and I started reading financial blogs like Mr. Money Mustache. I started reading books like Rich Dad Poor Dad, Cash Flow Quadrant. And in the span of about 2 months, I knew that I wanted to pursue financial freedom through real estate investing. But in order to do that, I also knew that I needed to get my financial house in order. At the time, we had about $80,000 in student loan debt. And so, after a lot of discussion with my wife, we made the decision to go ahead and sell our house. And we moved about 25 minutes to the east. We took $200,000 of equity that we had built through all of our cosmetic renovations and through, obviously the market cycle. And we took that tax-free because we lived in the house for 2 of the last 5 years. We bought a home. We paid off all $80,000 of my student loan debt, and we bought our first investment property, which was a duplex down in Tacoma. And that just completely changed our financial lives. That's kind of how we got in the game.
Wow. So, Aaron, before I ask any questions, I need to make a few observations here for all the listeners. The first thing is I agree with Aaron. It took me 47 years to go to a warm climate. If you haven't done it, you should really try it because it's an amazing thing. Josh got out to San Diego. I'm not a grumpy person anymore. I can get up and go to the beach. You know what I mean? It's nice. It's nice 9 months out of the year. In the wintertime, we get down into the 60s. So now it's a little chilly, right? But it's amazing. So everyone needs to try that. The second thing is Aaron's a marketer, because I like the word cosmetic fixer-upper with yellow tiles. In other words, it was probably a dump and he turned it into a palace, right? So there's nothing wrong with that. The third thing is it's the mom and pop, right? He's the mom and pop of the single family home. That's who he targeted. And there's mom and pop multifamily properties. That's what we talk about. So that's what you're looking for, the motivated seller. And they're in every single market, whether you're at the top of the market or the bottom of the market. You're always looking for those. And I love this is what I like most about it. He made a painful decision. He didn't make an emotional decision. He made a logical decision, which the vast majority of people can't make, is to actually sell his house, that he probably had a lot of memories there. He had a lot of blood, sweat, and tears. He changed the toilets. He did the tile work. He fixed the roof himself. He made that money. He pulled it out, and he got rid of personal debt, bad debt, and he actually bought an asset, and he bought his home on top of that. So if you're willing to do that, if you're willing to make that logical, tough decision early on, that will set you up for the future. Does that really wrap everything up, encapsulate everything you said from the very beginning? Does that make sense to everybody?
Yeah, what I'm excited about is I want to hear where the story goes from here. So you get rid of the personal debt, you buy the duplex, then what?
Right. So for a while, we started just building our portfolio in Tacoma. And so now we've got several rentals there. We went in, we rehabbed, we bought distressed assets or distressed properties, renovated them, raised the rents, and traded value for value, just like Jake and Gino talk about, right? And then refinance some of our money out of it. So we refied and rolled. And eventually we got to the point where, we had built up a pretty good portfolio in Tacoma. And during one of our quarterly meetings that my wife and I do together, and we always look at a real estate portfolio and see how things are performing. We just made the decision. We decided, the small multifamily, the 2 to 4 unit stuff is great, and it's a great place to start. But for us, we really wanted to scale our portfolio. The other thing we realized is that we were really highly reliant on one market. And even though Tacoma is a great market, and then you're getting a ton of rent growth there, and you're getting a ton of appreciation there, at the end of the day, it's just one market. And so we made the decision that we wanted to actually diversify from a geographical standpoint. And so we went out of state and we bought a 30-unit apartment complex in Kansas City, Missouri, as a joint venture with actually a previous client of mine. So this client, him and his wife, Carrie and Suzanne, great people, great investors. I had done a few deals with them before. So I already had that relationship with them where I knew that, hey, we work well together. We communicate pretty well together. I understand what their investment philosophy is. We partnered up as a joint venture. We went out, we bought a 30-unit apartment complex.
So when did you get your broker's license to go into real estate? And when you got that, was your mind always on getting out of pharmacy or just doing it together at the same time?
Yeah, so, it was interesting. So as we were going through this whole process of buying and selling our home and then eventually getting into investment properties, I realized that a lot of real estate agents have absolutely no clue what it means to invest in real estate. And that's kind of a sad thing, but they're really good at marketing. They're really good at showing homes. They're good at, filling out the contracts. But when it comes to running the actual numbers and understanding what makes a good buy and hold or what makes a good fix and flip, there's a huge gap there because that's a different type of property. It's a different type of buyer, right? And so originally I just got my license so that way I could go down and check out the properties myself. I could get access to the MLS. And then I realized I actually really like doing this. I love doing deals. I love helping people. And so I would start going to these real estate meetups and I would start talking about what I had done. And I would get people who are newer investors who would say, hey, I'm looking for my first investment property. Would you mind helping me out? And there's enough deals out there that I can't buy them all. So absolutely, I would love to help them out. And so I just started building up a client portfolio. And eventually I got so busy that, I kind of had to make a decision. I decided, am I going to continue doing this? Or am I going to just continue with my pharmacy stuff? And I decided, I really enjoy the real estate stuff. I love being a broker. I love helping people build their financial futures. And so I made the decision to go ahead and transition out of pharmacy.
So is it you made the decision or you and your wife made the decision? And how did that conversation go? How did that conversation go?
There's a lot of long conversations about that, but my wife's an amazing person. And I think she could see that there is a certain fire and a certain passion with me when I would talk about real estate or when I would help do deals or when I would, work with clients. And she could just tell that there was a lot of excitement in my voice. And so for her, it was really important that obviously the family was financially stable, But having done it for a few years prior to actually quitting, I was able to show, just through my track record and looking at my numbers, which I track very consistently, the number of closings, the number of new client leads that I'm getting, just looking at the pipeline, and she would look at it and say, oh, you know what, you're actually doing pretty good. So why don't you go ahead and give this a shot? And for me, the biggest thing for me was that, I didn't want to be 80 years old, lying in my deathbed, or 90 years old lying in my deathbed and looking back and saying, man, I really wish that I would have taken my shot at some point. I really wish that I would have, tried quitting my W-2 job and made the decision to go out and be self-employed and be an entrepreneur, right? The other great thing was having the Jake and Gino community and being around all of the people in the Jake and Gino community who are real estate entrepreneurs themselves. And some of these people are doing real estate investing full-time. Some of them are brokers, but they're all like highly, highly motivated people. And I think when you get around a community group like that, when you get around a mastermind group like that, it's easier because you see other people who are doing it. And Josh, as you and I know, and as Tony Robbins would say, success leaves clues, right? So if you can kind of follow those models, then you can be successful as well.
So Aaron, I really want to chunk it down even more, because I want to make it more personal for people, because they think, oh, you know what, Aaron did it, he left his job. Give us some of I'll give you one of the pros, and give us some of the cons also, because one of the pros for you, I remember with the week you left your job, the week after we had spoken, you're like, I went to an investor meeting and somebody was willing to give me $500,000 for a deal. I had that conversation. I probably never would have had that conversation if I was still doing pharmacy full time. So I think one of the pros is you all of a sudden have time to focus on one endeavor and actually go out and network more and really talk real estate and I guess start identifying as a multifamily investor. Whereas before you had the pharmacy, well, what are you? Are you a pharmacist or are you an investor? One or the other. And it's great because you did the 10% rule where you don't have to leave your job as soon as you start investing. You can wean yourself off, learn the trade, get in front of the people, learn it, and then when you feel comfortable, that's when you can cut the cord. So give me some more of the pros of leaving the job, and there's also cons of leaving the job. So let me hear both, in your example.
Yeah, absolutely. So I mean, the cons are you're leaving safe and secure, right? So as Robert Kiyosaki, says in Rich Dad Poor Dad, there are different words that describe different people, and when you're in the E quadrant, which stands for employee, it's safe and secure because you've got that W-2 paycheck, or at least that's perception.
I was going to say that. Yes, you're perceiving that it's secure because 6 years ago, somebody was losing their jobs and they get 20 years of their lives. And you know what? All of a sudden you see that. So I always said that about the restaurant too. I'm leaving the restaurant. It's a safe and secure job. But is it with Bite Squad and with Uber Eats and with everyone coming into competition and a $15 minimum wage and customers moving away and customers dying? So I didn't mean to cut you off, but everybody, if you're in a W-2 job and you think that's safe and secure, it might be. But by the time you take away your tax base, by the time you take away your cost of living, by the time you take away the inflation we're talking about, and the risk of being automated or the risk of losing your job or whatever, there's a lot of risk in that. So what Aaron is saying is really important. Take a look at that. That is a con because you are getting a paycheck, but you know what? The next downturn, you may be the next person that's getting laid off. So.
Right. Yeah, absolutely. Some other things that come to mind is it's typically a lot easier to get a standard 30-year conventional fixed rate mortgage. And I guess I have to say that because I'm a real estate broker and I work with this stuff on a daily basis. But when you are a W-2 employee, the banks or the lenders sometimes will perceive that as more safe and secure, quote unquote. It's still definitely possible to do it. And there are lenders out there that, if you're a 1099 employee as a real estate agent, or if you're making rental income, that it is certainly possible to do. But just something to keep in mind is that you may have to build up. And that was actually one of the reasons and the motivating factors for me and why I waited a little bit is because I wanted to have 2 years of 1099 income that I could show my tax returns.
That's excellent.
Ultimately get a mortgage. And then the other thing I would say is just that, I think when you are, one of the big things that trips a lot of people up is healthcare, right? So usually when you're in a W-2 position, depending on obviously what you're doing, you will have access to healthcare either through your employer or through some sort of subsidized plan. We ended up just getting out and we've got an individual and family plan, and it is a little bit more expensive and you just have to work it into your budget. But that was one of my limiting beliefs, right? That was one of the things that to me, I always thought, gosh, I can't quit my job. because what am I going to do for healthcare? Well, when we actually look at the numbers, we're paying a little bit more than we were previously, but it wasn't a huge substantial difference. And I think for the quality of life and the enjoyment that we get from being entrepreneurs and being able to go out and build our own dream, it's definitely worth it. So those are a few of the cons. Some of the pros, Gina, I think as you alluded to, I love the acronym FOCUS, follow one course until successful. And it's nearly impossible when you're working 2 different full-time jobs. You've got 2 kids, one that's 4 years old, one that's 1 year old. And then on top of that, you're trying to grow a real estate investment portfolio. I mean, it's impossible to just pinpoint and dedicate the amount of time that you really need to be successful. Not just to be successful, but to really dig in, right? And to really grow and be part of that, that upper 1%, of highly successful people in any given industry. There's just not enough hours in the day. And I don't sleep a lot as it is anyway, but even for me, it was very, very, very difficult. So I think that having the time to focus, having the time to be able to go to lunch and meet with some potential passive investors. This guy was a mortgage broker who I had referred a lot of business to, and I knew that he was potentially interested in doing passive investing in apartments. And had I never taken the leap, or have I never, given myself the time to focus on just being a real estate investor and a real estate agent, I probably never would have been able to go and meet and have those conversations. Right? So, your time is the most important resource that you have. You have to just be able to use it in a very, very strategic way.
So explain the feeling when you decided to say goodbye to your job. What'd that feel like?
Oh, it's definitely scary. I'm not going to lie. I mean, and I think that, you almost have to be inhuman to some extent to not think that that's scary. But it's also really exciting. And it's also a new opportunity. It's a new challenge, right? And I think that as an entrepreneur, most entrepreneurs, they really thrive off of that, right? Because it's ultimately, you get the chance to build your own dream. You get the chance to set your own schedule. I'll tell you, one of the things that I would probably never be able to do if I hadn't quit my job is, we've got this trip planned in mid-November to December, and we're headed out. We're going to go for an entire month down to Florida. We're going to go stay in Orlando. We're going to get seasons passes to Disney World and just hang out and take the kids there and have a blast, right? And I've been able to automate my real estate investment business enough here so where I can do that. And as an agent, stuff kind of slows down a little bit during the holidays, but I'm still going to have the ability to work on stuff, while I'm out of state. And if I was in a W-2 job where I have to be in a chair at a certain amount of time, for every day, or be at a check stand or whatever that is, that wouldn't be possible, right? So again, it's that flexibility that really excites me, being able to plan your own schedule.
So Josh, this is important for all the listeners out there. If you're thinking or considering about it, write down the pros and write down the cons. Think about it logically. It's going to be scary because it's something new, but if your pros outweigh your cons and you have the ability to do it, my thing is when you can get to 65, 70, 75% of what income you need, that's when I think it's the time to let go, because if you can focus over the next 12 months on your business, you're going to get that extra money. You might have to be lean the first year that you're doing it, but let me tell you, over the course of it, that's an amazing story. Taking a month off and going down to Disney during the winter time when it's going to be warm down there, the weather's going to be beautiful. Never would have been able to do that. That is priceless, because your children are only young once. You're only going to be able to do it once, and you're going to look back at it when you're 67 years old and you're like, oh, my kids are out. I never did something like that. So everybody out there, if you're considering doing it, Aaron didn't do it recklessly. He's like, you know what? I bought this property. I'm out of here. He had a plan. He got rid of his debt. He got rid of his house in order. He started educating himself. He started looking at other opportunities. He was radically open-minded because he's like, I'm going to go out of market, and everyone says you can't do that, but I'm going to get educated and learn how to do that. So there's a lot of steps in this process, and he's outlined a great plan for everybody who's listening. I want to get to this 30 unit because I know it was a really awesome deal. There was a lot of pitfall. I remember having calls with you back and forth about the due diligence, about the roof, about what was going on. What was the biggest, scariest part about this whole deal for you as you were going through it?
Well, so up to that time, we had never done what I consider to be a commercial multifamily property. And when I say commercial multifamily, what I mean is 5 units or more, right? Because we knew properties are evaluated differently, they're financed differently. Your due diligence has to be different. There's different requirements because they're a commercial building. Honestly, there's different types of contractors you have to hire, right? And never done that before. And so that's why we really went out in search of not just information and education, but also mentorship, right? And there's a big difference between those two. You can find information just about anywhere. I mean, you can get on the internet, you can get on BiggerPockets, and there's a lot of great information out there that you can find for free. But really with mentorship, the difference, I think, to me is being able to call up Gino and say, hey, Gino, can we jump on a call for 30 minutes real quick? We've got this letter of intent in. What do you think about this? Let me just make sure that I'm seeing the deal and you're seeing the deal in the same way. Or being able to call up Dylan, one of your guys' underwriters, who's just fantastic, who does a great job for you. And run a deal by him. I was just on a call with him last week, looking at a 62 unit, and we had some really good conversations, and it just either reaffirmed what I was thinking, or he gave me some new perspectives. And you don't get that same level of intense coaching and mentoring unless you're a part of a community like Jake and Gino, right? It's very, very difficult, I should say, to find. Not impossible, but it's challenging. So back to the 30 unit. So we found this deal through a broker. It was originally listed for about 1.35 million, and we actually made an offer on this back in November. So we went out a couple times, we toured the market. One of the things that I'll say, guys, is that if you're looking to invest out of state, you got to get boots on the ground. You have to go out there, you have to visit, you have to talk to the brokers, take them to lunch, do whatever you're going to do, and put a name with a face, because otherwise you're just one of another people, one of the many who are calling them off of LoopNet or whatever.
You're a tire kicker. You're a tire kicker. You're a tire kicker, basically. You need to go out there. That's an important point. I need to stop for a second, because if you're going to be an out-of-state investor, I've done it before. I've flown out to Rochester. I've flown out to Cleveland. I've come down to Jacksonville. Once you meet the broker and you do a property tour or two, they know you're serious. They know if you have your credibility book in hand, you have your business plan in hand, and you have your acquisition criteria, and you're telling them what you want, you're prepared. You're going to be 80 to 90% ahead of what the majority of mom and pop investors are. So I think that's an important point. Thank you for that.
Yeah, absolutely. So, so we went and we toured the property in November. We actually put in an offer, and the broker just said, look, we've got this other offer already in, it's higher than this one. And so the seller actually selected a different offer. And so we just said, okay, well, that's fine. We move on, right? So, that's just going to happen when you're investing in multifamily properties sometimes, is you're not going to win every bid, and you shouldn't win every bid, because if you're winning every bid, that probably means that you're coming in too high, right?
That's right.
So fast forward to January, and we get a call from the broker saying, hey, look, guys, the deal's falling apart. Buyer failed to perform. They actually never even put in the earnest money, so I don't know why it took so long for the deal to fall apart. And the broker was ticked. The seller was ticked. And they wanted to know, hey, are you guys still interested? So we said yes. But now we also knew we weren't really competing against anybody else who was interested. So we actually came in even lower. We lowered our offer price and came in, and the seller ended up accepting it. So they accepted the offer at $960 originally. So we were in contract at $960. And then from there, we went in and we started doing our due diligence. Now, keep in mind, the walkthrough was back in November. We started our due diligence process in, I think it was late January, early February. So when we went in and we started doing all of our due diligence on site, again, we flew out. First thing that happens is that I start through the property. I get up to the third floor, and all of a sudden I see this bucket on the floor in the apartment, in the hallway. And I look up, and sure enough, there's water that's dripping down into this bucket. And I'm like, oh, great. So now the roof is shot, right? If you're doing a walkthrough, you're not going to necessarily get up on the roof and examine all that stuff. If there's a crawl space, you're not necessarily getting down into the crawl space. At least that's not what we did for our walkthrough. And so, right away I knew, okay, we're going to need to make sure that we get this taken care of. Some of the things that I think we did right is that we had a bunch of contractors lined up during our due diligence process. I think we ran about 30 contractors through that building because for one, we were brand new to the market, right? So I didn't know which contractors are going to give me ridiculously high bids, which ones are going to give me the ridiculous low bids, but I don't necessarily want to work with. And so we wanted to get 3 bids for a lot of this stuff. And this was a really, really heavy value add deal. So our renovation budget for this was about $350,000. So we're putting, what is that, 11,500 per unit. And obviously not all of that is going into the units. In this case, a lot of that was HVAC. So we ended up replacing about 2/3 of the HVAC. So about 22-ish roughly. Brand new roof. Brand new roof was expensive. Not only did they have to do the full tear off on the flat roof and put down a new TPO layer, they also had to tear off all the corrugated metal underneath it because it was literally all rusted out. I mean, it was almost like powder. It was disgusting. So yeah, heavy value add deal. And I think just, you would ask, what are some of the challenges and what was some of the scary stuff? Some of the scary stuff was the long list of items that we had to fix on this building in order to get it up into good shape. But we ended up getting a great price on it. We ended up being able to negotiate the cost of the roof, which was about $85,000 off of the purchase price. We also got a seller credit. And one of the ways that I think one of the things that we were able to do was we were able to go in and do a really thorough due diligence. And the way that we learned that is through the Jake and Gino community, through using your guys' system and making sure that we were checking everything. So
that's awesome. So Josh, I need to, before we take a break for sponsors, I really need to really dive down into this because there's so many things that Aaron did right on this deal. The first thing is he followed through. I mean, actually kept in touch with the broker. So when the deal comes back, and a lot of deals do come back because this first guy probably freaked out and saw a bucket on the hallway and said, I'm not closing this deal, right? So that's the first thing. The second thing is he had a motivated seller. Mom and pops need to have motivated sellers because if you have somebody who's not motivated, you're not going to get you're going to get a retail deal. You're not going to get a deal that has somebody who wants to sell a property. They're just going to go to retail. They're not going to go wholesale on you. Staying engaged with the broker is the most important thing that I saw that Aaron did on this deal. And actually what I like about it is I'm sure that he sent over his underwriting and said to the broker, $1.3 million really is hard. And this is a lesson for everybody. As the market starts going downhill now, these brokers are still pricing these properties unrealistically. A lot of the sellers are going to start getting frustrated because brokers are still going to be overpricing these properties as the market's resetting. So it's going to give us the ability to actually work with a lot of these motivated sellers that need to sell. At $1.3 million and you lock in at 800, and my students are always asking me, well, what do you do to lowball offer? And lowball offer is realistic if you have your underwriting in place and you send it over and you can substantiate the numbers. You can at least save face with the broker and say, I'm sorry, I can't pay $1.3 million with all these repairs and with the cap rate, let's say being 7, and you're pricing it at a 4 cap. I just can't pay that. So there's a lot of things there that really resonated with me and that really you saved a ton of money on. Let's just take a quick break for our sponsor. We'll be right back.
Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created. Buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply.
Okay, Aaron, before we get into the short answer questions, I got a question for you. So after you reposition this unit, what do you think the value of that complex will be, and what will you be all in it for?
Right. So, so I think, as I mentioned, so we ended up getting the final purchase price was like $875. And we got a 5K credit. So I think we're all in at about $870 there for purchase. And then on top of that, we had about a $350,000 renovation budget. So I don't remember exactly what that adds up to, but we believe that based on the cap rate and based on the fact that this is now going to be a cash flowing asset, meaning that the cap rate probably isn't just going to go up as a result of that. It's actually going to come down because people generally pay more for stabilized assets. That's what we've learned through the community. We believe that this property is going to be worth about 1.5. So there's definitely some spread there. Potentially even more. I'm trying to be a little bit conservative just because when I run my numbers, I like to be a little bit more conservative. But this is an area where, we bought for $29 a door. We're putting in, let's say, 11 a door, 11 and a half a door. And stabilized stuff is selling for over 60, over 70,000 a door. There's a lot of room for growth there, I think. Wow. So buying right. And now we just got to manage it right? As well.
That's awesome. Congratulations. That is great.
Yeah, way to go with that. What advice would you have for a listener that's trying to get into their first multifamily deal?
Well, I think the first thing is to get educated, right? Because if you're not educated, if you don't know what you're doing, if you don't understand how multifamily property financing works, especially on the commercial side, you're going to be at a huge disadvantage, right? And you're going to be at much higher risk. So I think the quote that I heard the other day was, education is one of the things that you can do to maximize your return and to reduce your risk, right? And so if you're not investing in your education, automatically you're going to be at a huge disadvantage. It's going to be much more risky for you. The second thing I would say is to find a mentor. Success leaves clues, right? So if you want to do something, if you want to accomplish something, it's a lot easier to follow in the footsteps of somebody else who's been successful doing that same thing, as opposed to trying to reinvent the wheel yourself. Like that's just silly. It's going to take you way longer. You're probably going to end up getting frustrated, and ultimately, there's a decent chance that you're going to lose money because you're not going to know what you're doing, right? So I think those are two huge things. And then the third thing is just don't quit, right? Just keep going out there, keep showing up, keep flying into that target market, keep meeting with those brokers, keep following up with those brokers, keep underwriting deals. Because eventually, it's a numbers game, right? You're going to look at so many deals. And if you've defined your criteria really, really well, and if you know what you're looking for, you're certainly going to look at fewer deals. You shouldn't have to look at necessarily 100 deals just to find one or two, if you've really done a good job of defining your criteria. But keep going, keep following through.
Love that. What about your favorite book and why?
Yeah. So everybody says Rich Dad, Poor Dad. And that, I think, as I alluded to earlier, that was definitely a book that got me started. But I'm actually going to give you a different one. I'll give you two. So Kiyosaki wrote another book called Retire Young, Retire Rich. And it just has some really good lessons in it. One of the things is using leverage, and that's both from a financial standpoint and also from a team building standpoint, right? Like Gino, you run a fairly good sized organization right now, and you've got all these, you're multifaceted, multifamily. That's what you guys preach. Well, but Gino, you yourself, you don't have time in the day to run every single division of that multifamily company, right? So you've got to leverage other people who've got great skill sets, who and you've vetted are going to be great team members for you. So leverage from a team building standpoint, and then also leverage from a financial standpoint. Obviously, that's why we like buying real estate. That's why we like buying multifamily assets. It also talks about just having a strong, reliable team who are on the same page with you, who think in a similar way, not who think exactly the same, because you don't want to necessarily get into groupthink, but people who can kind of be a sounding board and who are on board with your vision. And so those are just really, really important lessons. And then the other one that I'll mention is the book on rental property investing by Brandon Turner. And the reason I mentioned that is because that was one of the first real estate investing books that I read. That's what helped me understand, what makes a good buy and hold investment property. And that really helped us purchase our first duplex.
So Josh, I jump in on that entrepreneurial thing. It's so hard to leverage other people when you first start out, because as an entrepreneur, you're the I'm a mentality. When you're small, I'm gonna do this, I'm gonna do that. And I think that's the hardest thing, is when you need to start scaling up and start bringing other employees on, because sometimes your ego gets in the way where you think you can do a better job than everybody else. And maybe you can, but I'd rather have somebody do 80% of what I can do, so I can do other things and hire more people on. And that's the biggest struggle for everybody when they start working for themselves and I had that at the restaurant. That's why I only had one restaurant. Now we have over 1,500 units, is because I was the man at the restaurant. Everyone knows Gino's Trattoria, and it was really hard to let go of the kitchen and give that to somebody else. And I struggled for years and years, because I was raised that way from my father. My father, it worked 30, 40 years ago. You didn't have to leverage 30, 40 years ago. You could be at one occupation, make a great living, great middle income, but nowadays it's not possible to do that. It's not possible to stay in one place and not leverage other people's abilities. And obviously there's people that can do a much better job than I can. I'm looking at legal contracts right now. I want to shoot myself. I mean, it's like so mind numbing, employee handbooks and all. And if you can find a team member that can really help you with that, I would say go out there and go make it happen and take the risk and think back, what, is it me? Is it my ego that's holding me back, or can I get somebody to help me out? So that is an excellent point. I love the point you made. Thanks for making that.
Love that. Aaron, what about your best habit for success?
So I don't know if this is my best habit, but one of the things that my wife and I do that has really been great for us is that we actually go on a little mini retreat every year. So we take, it could just even be an overnight thing, and we get away and we talk about, we do goal setting, and we talk about the previous year. And we do goal setting, and we try to do it in just about every aspect of our lives. So, we talk about, who do we want to be in our community? Who do we want to be in our church? Who do we want to, what type of investments do we want to make this year? How many times do we want to try to get together with the neighbors and with, friends and family? And we just go and we start mapping out our year, and we try to be really, really intentional with our time, because we know that if we aren't, then life gets in the way, right? And other stuff will start consuming our time. So that's been a really great habit that we've done the last few years. Has been very successful for us.
That's awesome.
Love that. Gino, this show has had a ton of golden nuggets. Do you want to sum up some of them for the listeners?
Well, the last thing I'll say, I mean, everyone who wants to become financially free and wants to leave their job has to go back and really listen to this again. And if you have any questions, Aaron's going to give out his information at the end. If you want to reach out to Aaron, that would be awesome. You want to reach out to me and ask me questions, because I've done that also. And it's not easy, but it's so fulfilling. It's so rewarding. So one of the last things that Aaron said that really resonated with me is don't quit. It is a long game, and it's hard. Patience, persistence, but willing to walk away. And it's like the farmer that I say, you plant the seed in the spring and you hope you get something in the summertime. And that's what it is with being an entrepreneur. And that's what it is with going out on your own. And if that seed doesn't come out in the summer, you do it again next year. That's how it goes. And some years will be fantastic and some years won't be as fantastic, but you're always growing and you're always learning. And if you can not quit and be persistent, there's only 4 or 5% of the people out there that follow that mantra, and they're the ones who are successful. So guys, long game, don't quit. Education times action equals results.
Love that. Aaron, how can the listeners get a hold of you?
Sure. So I'll give out my email. That's probably the best way to get a hold of me. It's Aaron Nelson, so AARONNELSON, all one word, 034@gmail.com. So Aaron Nelson 034@gmail.com. And then I've also got a website you can go to, and that's Aaron Nelson Realty, just the way that it sounds, .com.
Awesome. I want to thank Aaron for being an amazing guest on the show and sharing his Mover and Shakers story. Guys, if you want to be the next Movers and Shakers guest, email me, josh@jakeandgino.com. If you like the show, please leave us a review. And until next time, let's make it a Movers and Shakers week. See ya, everyone.
Thanks, Aaron.
That's good. Thanks, everybody.